Roller and I will be chairing this meeting today. Sad to say that this will be my last time chairing an NCOIL meeting, and I thought that Will was going to take it easy on me, but after looking at the agenda today, I see he has no chance of that. I'll ask for a motion to waive the quorum.
So moved.
And a second. All in favor? And the quorum is waived. I also need a motion to approve the July 16, 2022 and September 29, 2022 committee meeting minutes. We have a motion and we have a second. All in favor? Approved. We'll begin this committee meeting today with a discussion on Idaho's efforts to lower the uninsured motorist population. Over the past year, we've had several conversations on how states can utilize different methods to lower the uninsured motorist population. Today, we're going to hear from Idaho Representative Rod Furness, who will brief us on some of the legislation he has sponsored in Idaho and about this topic. That legislation appears in your binders on page 275. So at this time, we'll go ahead and turn the committee over to Representative Furness.
Thank you, Mr. Chairman. Appreciate it. This is my fourth NCOIL meeting. I just want to say how kind the leadership and the administration's been to me. It's been a wonderful experience for me to get to know NCOIL. I left 4-degree weather at my house in Idaho, 2 inches of snow, and I came here to golf, and I almost froze to death. It was so cold. But I've been an agent since 1986. I spent 25 years with Northwestern Mutual, then became an independent agent. In our office, we have P&C agents and all kinds of agents. It's been a wonderful ride for me. We work mostly with C-suite, and we do self-funded health plans now across the board. So anyway, today I wanted to tell you that I live about an hour from West Yellowstone, about an hour from Jackson Hole. You're welcome to come and visit. We don't want you to stay. Idaho is one of the fastest growing states in the nation, and we're having trouble keeping up with the growth there. But we'd love to have you come visit. I've got a few rooms in my house. You're welcome to stay. We have a population of about 1.7 million people in Idaho right now. I was just going to tell you we're number one in potatoes. You probably didn't know that. We also are number one in barley, hay, peppermint oil, and food trout. Very few people know that. We have voted number one in economic momentum the other day. Also number one in state driven by tax policy, and also number one in state revenue growth during a pandemic. We didn't know there was a pandemic in Idaho. We didn't hardly shut down. We kept on going. I lost a few friends, and I wish it wouldn't have happened, but I'm glad we got through it. Let's talk about Idaho, what they've done there to minimize the uninsured motorists. HB 179 is found in your books on page 276, the fiscal notes on 278. I'll speak on the pros and cons of the bill we passed 3 years ago. HB 179 is not a perfect bill, but it's not bad. And it needs to be updated, and we hope to do that this year after 3 years of data. Idaho before the bill had no enforced mandate prior to HB 179. We had a law that said you needed to have insurance, but we didn't have anything to say that to check on it, or any way to find out if you had complied with the law, except when you got a ticket or were in an accident. And that's a little too late to find that out, whether you're insured or not. The Speaker of the House asked me to champion this bill. They had been trying to do it for 10 years. It was only due to the technology changes that we were able to put this together and get through it. The Senate passed it and the governor signed it. The challenge was to make the clerks at the DMV office not the bad guys, and to continually check insurance after the registration. Many states require insurance at registration, but then there's no check after that. How do you know they have insurance after the registration? So we started to work on that. HB, again, is not a perfect bill. As we go through it, I'll let you know some of the pros and cons of the bill and some changes that we'll make to make it a better bill. HB 179 uses an online program we already had for commercial vehicles, and a program that our police officers could access all vehicles to see if they had insurance. But this was only if the insurance company in the state of Idaho cooperated at that time and downloaded their data into our data bank. Many did not, some did. none of the insurers downloaded on a timely fashion, so a lot of the information the police officers were getting were outdated and unreliable. HB 179 mandated that companies dump their data into our system at least monthly. If you're keeping track of this bill and you want to know how to write it better, I would suggest you don't say monthly. And that's one of the changes we're going to make. We're going to have them dump at least bi-monthly. And we're going to set a date on that day they dump, probably the 15th and the 1st of the month, so that we can keep track of that data. So what this program does is it matches the VIN number with the insurance policy to see if they have coverage. So in the bill, in 2.4, the department shall establish a program to match information from the online insurance verification system with the motor vehicle registrations to determine whether the owner of the motor vehicle has established financial responsibility. If they don't have financial responsibility, then their registration was canceled. How do we do it? The insurer is reporting the data to the verification system. Again, it says monthly in my bill. Again, we'd change that. The department performing a periodic match at least semi-annually or semi-monthly, says monthly in the bill, of the information from the online insurance verification system with motor vehicle registrations to determine whether the owner of the motor vehicle has established financial responsibility. At the first test we did, when we actually ran the test, we had 363,000 vehicles that were uninsured in the state of Idaho. What we found out, there was a lot of false positives in that first test. So as we held the data constant and we looked down the road 2 months, we got that number down to about 100,000 vehicles. And that's where it is today. We think there's about 100,000 vehicles in our state that go on uninsured or were going on at that time. So what happens, the way the bill works is we match it the first month, we match it the second month. If your car doesn't show up as insured in the second month, you get a letter in the mail that says, unless you can show us you have insurance by the end of 30 days, your registration will be canceled. Now, in the bill, and you can read through it, it tells you that you have an opportunity to go in and tell us why your car isn't insured. Is it stored? Did you sell it? Is it insured under a business policy? And let me see the other, did I hit the slide? Can you move that to the red thing? That one. So drive insured, be safe in Idaho. It allows the person, they receive a letter that gives them this instruction. It allows the person to go on there and tell us if your vehicle is stored or covered in some other way. And they can do that. A lot of agents have gotten on board and helped us with this program where the person maybe waited till the 29th or 30th day before the registration was canceled. And on that day, they go in and they can explain to us, upload a document that says, I'm insured, and their registration won't be canceled. If their registration is canceled, the current bill says that they had to pay $75 fee plus re-registration to have it, to get it re-registered. That's about a $300 hit to a family if they let that go on. I would suggest that on the bill, we picked $75 because we didn't want to be onerous, but I will submit to you that it's not enough and that it needs to be higher. Probably in our state, probably $150 is where it needs to be. And in this bill, it says that the fees go to the highway department. I would also recommend, and we'll fix it this year, that part of that fee goes back to the county where that ticket was issued or where the registration was canceled so that the county gets money to re-register those vehicles. So we don't have an unfunded mandate back toward the county or the parish, as they would say in New Orleans. But it's a county in Idaho. So with that, the 3 months gives us time to tell if that vehicle's been sold, if it's been purchased by someone else. But what we've seen are some false negatives in that because the insurance companies aren't downloading it, maybe they're hitting and miss on the download. We may see times when we'll see a big increase in uninsured motorists in Idaho because the insurance companies haven't downloaded in a timely manner. Some companies download almost every day. Some companies download every other week. Some companies don't download until a month and a half. And when that happens, all their clients get letters that say they're uninsured, and they begin calling their insurance agent. So it's important that the companies download on the right days. What we've seen from this, though, let me go over the fiscal note real quick. The fiscal note for Idaho is $345,000. You'll see in that fiscal note we put some money in to advertise this program. We wanted people to know about it. It took about 3 full-time employees more to run this program. And the next year, though, we took in $408,000 in fees. And so it was almost a wash on the cost of the program to run it. There are states that do it, that have vendors that do this kind of merchandising or keeping track. In Idaho, we figured we could save about 75% by keeping it in-house versus hiring the vendor. So that's what we did. You'll see on the fiscal note we have postage, we have computers. We also had to do a major change to the computer system, cost about $30,000 to make sure that we could match those VINs appropriately. Interesting enough, when we matched those VINs, we found 10,000 VINs numbers that weren't accurate. The VIN was wrong, the owner was wrong. We were able to clean that system up by implementing this program. The next year, the program actually went higher in cost, and we think that was due to the growth in Idaho, actually. Some of the other things that we saw in Idaho, the state police are really lenient on uninsured motorists. They need to be tougher, I think. But when they'll meet, if they pick someone up and they don't have insurance, they'll give them a warning. And they'll even give them a second warning sometimes. By the third time, though, they give them a ticket. We were seeing 1,000 tickets a day, or a month, 1,000 tickets a month in Idaho for uninsured motorists, which means they were picking up a lot more people. After the program went into place, we were seeing 500 tickets a month. So it almost cut those tickets down by half. And what it did is it made Idahoans aware that insurance was important. Agents became aware and were helping clients register their vehicles if they went without insurance until the 89th day. And it became a program that Idahoans could understand. Now it's not perfect. We still have some people call in that are upset because they haven't read the letter they get about storing their vehicles. And in Idaho, if you have a Corvette, like the chairman probably has 3 or 4 Corvettes, and but in Idaho, he can only drive those Corvettes 4 months a year. So he has to store that Corvette. He'll take the insurance off. What we're hoping eventually is, and so that client has to go in and say it's stored so that the registration maintains itself. But what we're hoping, for example, Liberty Mutual, when you go in, you can go in on your app. You can store that Corvette, Mr. Chairman, just so you know. You can store that Corvette, and when you store it, we're hoping that pretty soon we'll get a marker from the insurance company that says this car is stored. If that were the case, then people wouldn't have to go into Drive Idaho, Drive Insured, and mark it as stored. And we hope technology will keep up to us. And with that, Mr. Chairman, I would hope that you'd come see me in Idaho with your Corvette in the summertime.
Thank you, Representative. I don't have any Corvettes, but if you want to come visit the home of the Corvette in Kentucky, we will welcome you there anytime.
Love to do that.
Do we have any questions or comments from legislators?
Hello, I'm Senator Mike McClendon from DeSoto County in Mississippi. If they end up in the database where it's showing they don't have their insurance, does that go against their credit score at all?
No, sir. No, it doesn't hook to their credit score at all. It keeps, all of it is internal in the state of Idaho. We just notify them that we know their car is not insured, or we believe it's not insured. We tell them to go on our website if it is insured or stored to tell us what it is, upload the data to prove it, and that's it. That's as far as it goes. We did have a lot of fights with insurance companies when I first started putting this together. They didn't want to disclose their data. They were afraid we were going to mix the data. We had to make sure that they felt okay about sending their data to us on a regular basis.
Thank you, sir.
Representative Lampton.
Thank you, Chair. Just a couple questions. In the law, in the 179, did you indicate, did I hear you correctly? It was compulsory. In other words, the carriers did not have to report? You made it optional? Or did I misunderstand?
No, they have to report. It's
Okay.
not optional.
Okay.
They would have liked it to have been optional.
Okay,
but
right.
no, it wasn't.
Then you said you started at 300,000 plus uninsured, and then it went down to 100,000. Does that mean 200,000 registrations were canceled? Or, I want to be clear on the data. Did it effectively reduce the number of uninsured cars?
What it did is when we first ran the test, on that month, there was 363,000 cars that said they were uninsured. But that meant that at that particular time, that's how many there were. But as we left that data stagnant for, say, the month of January, and we checked on that data in February and March, it went down to 100,000 after that. So what it told us was that people were buying, at any one time, there might be 363 cars, or 363,000 cars uninsured, but they were in the process of getting them insured, or they were insured and the insurance company hadn't downloaded the data to us. So there's a lag of about 2 months there. Does that clear that up? Okay.
So do you have any overall data about the actual results of, was there a reduction in, after the?
Yes, by the third test, we ended up sending out about 35,000 letters after the second month. So it not only came down to 100,000, it actually came down to about 35,000 by the time we sent the letters out.
Okay.
Good
All right, we
question.
got 2 more questions, then we'll move on to the next topic. Senator Lang.
Very quick. Thank you. Just curious about the notification process and the accuracy of it. Addresses change, people move, cell phones change, emails change. Curious about the accuracy of the notification process and maybe any backups or redundancy plans.
Good question. When the insurance company sends us that data on the VIN number, we also get the most current address. So we've had very few letters come back because of that information that we have. But we think we could cut those costs down by quite a bit if the insurance companies would download twice a month rather than once a month. We think it would almost cut the false positives in half if we could get a better connection. And what was your second question? I'm sorry.
I think you got it. Your primary source is direct mail, correct?
Yes, we didn't email, but they can, in the bill, you'll see that if they want to, they can email proof of insurance back to the department, and we'll accept that.
Thank you.
All right, thank you. And I think that question was the same one that Representative Westfall wanted to ask as well. So thanks for the presentation. If anyone has any thoughts or suggestions on this topic, please reach out to Representative Furness or NCOIL staff, and they'll be glad to work with you on that. Thanks again.
Thank you.
We'll go ahead and move on to the second presentation of the meeting, and this will be a presentation on developments in the surplus and excess line insurance marketplace. With us today are John Meets of the Wholesale and Specialty Insurance Association and Howard Green of the Excess Lines Association of New York. When you gentlemen are settled in, please introduce yourself, and you may proceed with your presentation.
Thank you, Chair. All right. Thank you, Chair Rowland and the committee for the opportunity to speak here today about the excess and surplus lines market. I am John Mates, Senior State Relations Manager for the Wholesale and Specialty Insurance Association, and our association represents brokers, carriers, and service members operating in the surplus lines industry. So today we plan to give you a bit of a crash course on the industry, give you some updates on some recent market and regulatory developments. One quick point I want to make is you may hear me say surplus lines. You may hear me use the New York term excess lines. You may hear the word non-admitted. I'm going to try to stick to E&S as a catch-all for all those things. But for our purposes today, just understand that those are fairly interchangeable words. So each state has established public policy that provides a legal framework for obtaining insurance when the standard or admitted market is unable or unwilling to write a particular risk. And that was not an accident. Your predecessors, your colleagues, and many of you were involved in those decisions to set that public policy. So what kind of risks are we talking about? Really three main categories. Typically, they fall into high-capacity, unique, or emerging risks. And here's a few examples of high-capacity risks. Obviously, you can see skyscrapers, large property, terrorism, political risk, special events, festivals. Here's a few examples of unique risks: medical research, product recalls, pollution cleanup. And here you see a couple of examples of emerging risks. It is entirely likely that someday the cannabis industry will be insured through admitted products. Same with autonomous vehicles. But until the admitted industry obtains the experience necessary to do that, the E&S market will step in and make sure those industries are insured. So I want to take a minute and talk about how our industry is regulated and really emphasize that, yes, it is regulated, contrary to what you might sometimes hear. In the admitted market, each state regulator has the opportunity to regulate any carrier selling products sold within its borders. But E&S carriers are regulated by their state of domicile for the purposes of solvency, and the licensed surplus lines broker is responsible for most of the compliance in the transaction. They are responsible for complying with all the relevant state laws. They're responsible for placing coverage with a financially sound insurer, reporting that transaction and any relevant data to the home state, collecting and remitting premium tax, and again, assuring that each transaction is in compliance with all of the applicable state laws. So why are E&S insurers able to write risks that are rejected by the admitted market? Well, again, each state has established public policy that provides for freedom of rate and form for E&S policies. And our members are able to do their job because they uniquely tailor the terms of a contract to the needs of the consumer. So as we say, if you've seen one E&S policy, you've seen one E&S policy. And I think preserving that principle is probably the most important takeaway from my presentation today. But I want to reiterate, that doesn't happen as a first resort. So insurance can only be placed in the E&S market after it's been rejected by the admitted market. And how does that happen? So most states have a process for verifying a diligent search among admitted insurers has taken place. The traditional method for that is that a producer must obtain 3 declinations from admitted insurers. But some states are actually moving away from this recently. And why? Well, it can be burdensome. It's actually quite redundant for a producer to ask the same underwriter over and over if they're willing to insure a risk that they know darn well that underwriter won't write. And what we found is actually that the wholesale distribution system, you can see pictured here, actually has more to do with keeping business in the admitted market. And I think Howard's going to speak a little bit about that here in a moment. So 2 more quick slides, and we'll get into the current events. So first, in 2010, Congress passed the Non-Admitted and Reinsurance Reform Act, commonly referred to as the NRRA. This was a critical law for our industry because before it was passed, there was no clarity over which state had authority to tax and regulate multi-state E&S transactions. So the NRRA established that the home state, as defined by the law, of the insured has the sole authority to tax and regulate each of those transactions. So that brings me to my final point and why I'm here. Last year, the NAIC Surplus Lines Task Force appointed a drafting group to update their Non-Admitted Insurance Model Act to correspond to those changes that occurred in the federal law in 2010. So their work is now coming to a close, and we expect that model to be adopted either later this year or early next year. The good news is neither we nor the NAIC is giving anyone here any marching orders. This is not an accreditation standard, and even if it were, basically every state has adopted some form of law to correspond with the changes that occurred in the NRRA. But this may be an opportunity for you to take a look at your state's E&S laws to see if any updates are necessary, and we are happy to assist any legislators if you're willing to undertake that process. So my final note, I just want to thank actually Commissioner Donlin of Louisiana. He chairs the Surplus Lines Task Force, and his staff chaired the drafting group, particularly Tom Travis. They did exemplary work on revising this model and did it in extremely quick fashion, especially relative to some other model laws. So we just want to thank them for all their cooperation and hard work on that. And with that, I will turn it over to Howard.
Thanks, John. May I please have the clicker? Oh. Okay. So in your program, in your agenda, it says that I'm Daniel Marr, but I am not. Dan unfortunately could not make it, wanted to be here very much, so I'm here in his place. I'm Howard Green, and I am the Excess Line Association of New York Director of Government Affairs and Strategic Initiatives, which is a very long way of saying I do what no one else in the organization seems to want to do. Elaney, just very quickly, is a nonprofit organization that was created by statute in New York to facilitate compliance with New York excess line laws. So I want to give a little perspective on some of the things that we've been talking about. And what I'm going to talk about, everything I'm going to talk about is the way it is in New York, because we're a New York organization, so it's focused on New York. But I think it highlights the market nationally in many ways. The E&S policy count in New York is very small in comparison to the admitted market, and the premium is as well. If you see it standing by itself, it seems a little more substantial. When you look at the total market, it's a small part of the market, and it's dominated by higher risk insureds and unique coverage needs. So let's give an example of what I'm talking about, of the way that the E&S market sort of laser focuses on certain things in New York that admitted carriers don't want to do. We commissioned an independent study by Novastance Analytics to analyze the New York homeowners market. We did the homeowners market. We thought that was a pretty easy thing for most people to identify with and to get their arms around. In 2017, there were 20,000 E&S homeowner policies issued in New York. In New York, there are 2.86 million residences. That means if you look at New York residences, only 0.7% of residences are actually insured in the E&S marketplace. Again, in New York, there are two factors that the study found that drive homeowners' risks to the E&S market. One is increased wind exposure. In coastal areas, and the other, high-valued homes. Now, E&S homeowners policies are concentrated on Long Island. It's more than 60%. And if you know New York, if you see a map of New York, then you'll see that Long Island is the most exposed place in New York State to storms coming off of the ocean, juts right out into the ocean. Most of what's in the E&S market are within 1,000 feet of the coastline, most homes, and almost 80% of ENS premium insures high-value homes. Specifically, the ENS market has had more than a 90% share of windstorm risk homes, and that is those homes that are within 1,000 feet of the coast. In contrast, as you move to homes that are more than 1 mile from the coast, the admitted market had 99% of the market. The average insured value per policy in the excess line market of a home was about $855,000. So that kind of demonstrates what we were talking about, including in terms of exposure to wind and in coastal areas and high-valued homes. Let me give a specific example, and that is the example of Long Beach, Long Island, which is a place that got devastated during Superstorm Sandy back in 2012. If you look at the chart up on the screen and you look to the right side of the chart, you'll see total policies in Long Beach. And as of the time of Superstorm Sandy in 2012, there were 989 E&S homeowners policies written in Long Beach. And that was about the same a few years later. But by 2021, it was down to 419. That is well less than half. What happened in a relatively short period of time? Well, what happened is that after Superstorm Sandy devastated Long Beach, homes were raised, meaning raised literally, some of them higher up to avoid flood risk. They were raised, which means brought down to the ground, disposed of, and or they were rebuilt. And all of this was done with wind and flood risk mitigation designs. So what happened? As a result, many Long Beach homes became much more risk averse, therefore much more insurable in the admitted market. And as we've seen, the admitted market moved back into Long Beach, and the E&S market receded in terms of its role there. That's exactly the way the market is supposed to work. Now, how is E&S placed? I think John made some reference to this, but it's placed through licensed E&S brokers, and there are two types. One is a retail broker, and retail brokers represent the insured and go straight to the E&S insurer, go straight to the market. Wholesale brokers are brokers, as you would guess, where they're licensed. They deal with placing with E&S insurers, but they don't deal with the insured. They deal with retail brokers who are not E&S brokers. So as you'll see from the chart, the transaction share for wholesale brokers is overwhelming. It's 83%. The premium is a little different. While it still favors wholesale brokers, it's more of a 60-40 split. And why is that? Well, retail brokers tend to be large brokers that represent large risks, and they have a need for capacity. So they will have risks that are too large for any one insurer to write. An example would be you'd have a $700 million skyscraper. You're not going to get one insurer to write that, nor do I think you'd want that. So you go out to 14 insurers and you put together a program, and each insurer might take $50 million. Retail brokers will do that, and they'll access the E&S market directly. Wholesale brokers, on the other hand, serve the retail brokers on their difficult accounts, the retail brokers. Most retail brokers around the state and in the country are not licensed for E&S, and so they have to go through wholesale brokers. Now, in 2021, 8,162 retail brokers utilized wholesale brokers to place E&S risks. That is out of 48,000 total New York licensed brokers in New York. So maybe about 17% even access the E&S market through wholesalers. Out of those, 70% of the brokers who did that placed less than 10 transactions, 10 policies into the E&S market. And that is a pretty strong indicator to us that these retailers only go to the E&S market when that's what they have to do to serve their clients, to get insurance that they can't get in the admitted market. And there's a lot of incentive for them not to do that. They don't want to split their commission, which is what they have to do if they bring in another broker. They have relationships with their admitted carriers. Maybe they have direct bill. There are various reasons why they don't really want to go to the E&S market, but it's what they do when they have to do that. Now, market growth in the E&S market is often found in new emerging product categories, and one example of that would be cyber liability, and the numbers are pretty startling. The first full year of reporting on cyber in New York, we had 3,649 policies, cyber liability policies filed. This year, in the first 9 months alone, we were approaching 12,000 policies. That's become a much hotter area in terms of insurance. It's in the E&S market typically because it's not a settled area yet, and the admitted carriers tend not to want to write that as much. Certain products are consistently in the E&S market, and construction is the prime example in New York. 17% of the total New York E&S market is construction in terms of policies, 20% of E&S premium. And that's because if you look around the New York City metro area, you can't help but see all the skyscrapers. And when they are built, they're built in tight spaces and at great elevation, so it's more dangerous and more complicated. And in New York, there's strict liability for gravity-related falls when working on a construction project, so the risk is greater. So these risks come to the E&S market. Just as a quick aside, E&S insurance is almost 100% property and casualty. So when we're talking E&S, we're almost always talking property and casualty insurance. So some conclusions. The New York E&S market serves the need for which it was created, as it insures risks which licensed insurers choose not to write. And the small size of the E&S market, plus the nature of the risks, as demonstrated by the numbers that I've provided, sort of proves this conclusion. Our future expectations and aspirations for the E&S market would be that E&S will continue serving hard-to-insure populations. The market will be viewed through the prism of granular data, and what we mean by that is looking at the market, not just in general terms, but specifically what's insured in the E&S market, what's insured in the admitted market. That's when you get a much better understanding of why things are going to the E&S market and why things stay in the admitted market. Regulatory uniformity, which we believe will reduce costs and benefit insureds, and that goes past New York. And then also sort of an overriding objective that's not just New York, which is public policy, which is that public policy should maintain its focus on differentiating between the E&S market and the admitted market. And I'll give one quick example and finish off like this, that in the last couple of years during the pandemic, New York had some emergency regulations which impacted insurance very directly. And the New York State Department of Financial Services actually was very, very careful to maintain the differentiation between the E&S market and the admitted market when interpreting those regulations. Thank you very much, Mr. Chairman. Thank you very much for your time, and we'll take any questions.
Thank you both for your presentation. Do we have any questions or comments? Senator Hackett?
Yeah, I have actually two questions, and the first one will lead to the second one. So how much of the companies in the EAS are international companies? Because, you know, we see it a lot in the reinsurance alone, but how many are international companies?
Off the top of my head, I'll have to get back to you with an exact answer.
The reason I said that, I carried the legislation in Ohio is, Ohio used to require for an insurance company that was international 100% on, you know, of collateral. And we changed that in Ohio because, I mean, Ohio's a big insurance state. We had the potential of losing some decent amount of business. So we left it up. The insurance commissioner still can look at an international company and say they're not sure on that and still require 100%. But usually, we try to treat the international companies, because we all know it in the room that a lot of the big conglomerates are international companies now. So that was a question. I mean, is the E&S surplus, you know, the admitted carriers don't have secondary insurers that they use, so they're usually going to the reinsurance market, aren't they not?
They utilize the reinsurance market, sure. There is a decreasing number of the international insurers do have a decreasing amount of market share in the United States. The NRA dictates the terms by which they are regulated through the NAIC IID list, International Insurance Department. So that's how that works. Did you want to add anything, Howard?
Yeah, I would just add that in New York, and I believe nationally, Lloyd's, of course, is a huge player.
Lloyd's a big player.
So that's, they're
So
sort of.
is
they're sort of-
Zurich and Zurich and
they're
there's a lot of
huge.
others.
But most of the bigger ones in New York, I believe, are U.S. companies, or at
Okay.
least owned
That's
by
what I
U.S.
thought.
companies.
Thank you.
Any other questions from legislators? Seeing none, thank you all for your presentation. And if any of the legislators have questions, feel free to reach out to the speakers or the NCOIL staff.
Thank you very much
all.
for having us.
Thank you.
At this time, we'll move into item number 4, which is discussion and consideration of the NCOIL Delivery Network Company Insurance Model Act. We have 3 model laws to discuss today. We'll begin with this one, which I'm proud to be the sponsor of. We've been discussing this issue for nearly a year now, and we've made great progress, and I think today that hopefully this bill is finally ready for a vote. You can view the model in your binders on page 279. But before we proceed, I would like to note 2 minor technical changes to the model. The first is in Section 3B. The language will be included just to make clear that the insurance required to be maintained insures the driver of these delivery network vehicles. This is really just a belt and suspenders change, and is consistent with the intent of the model. The change is also exactly the same language that we have in the NCOIL TNC model, which has been adopted in almost every state. The second technical change is in Section 3E. A clarification will be made that coverage can be obtained by eligible surplus lines brokers or insurance companies. I will just note that this model is a great example of NCOIL being at the forefront of an emerging issue and being able to move swiftly to provide states guidance. You're certain to see this model introduced across the country next year. And we'll go ahead and hear from our interested persons now who would like to speak, and then we'll turn it over to the committee. We have Frank O'Brien from APCIA, John Schnautz from NAMIC with us. So Frank, go ahead, or John, whichever one. The floor is yours.
Thank you, Mr. Chairman. For the record, Frank O'Brien with the American Property Casualty Insurers Association. I am very pleased to be before the committee today in full support of this DNC model. This model is the product of the NCOIL process, which includes extensive consultation with state lawmakers, the use of a stakeholder process that had all of the parties at the table, which produced the draft in front of you today. It is a draft which maintains NCOIL's preeminent position as the place where you go if you want to have model legislation that appropriately regulates the shared economy space. This is the latest, but I don't think that it will be the last. So with that, Mr. Chairman, I commend you and I commend the members of the committee for your actions on this, and I look forward to its approval. Thank you.
Thank you, Mr. Chairman. John Schnautz, National Association of Mutual Insurance Companies. In deference to the committee's time, will be really brief. Ditto everything Frank said. We are also fine with the changes that you'd mentioned, and thanks to you and Delegate Westfall for carrying it. So appreciate it. That's all.
Thank you, gentlemen. Do we have any questions or comments from legislators around the table? Senator Lane?
I'm a little confused about when the coverage would start for this. Would it start when the delivery or the call for service is requested, or would it start when an app is turned on saying, hey, I'm ready for a job? Does that make sense?
With your permission, Mr. Chairman, I'd like to ask Brad Nail to come to the table in order. Brad was the person who led the stakeholder conference on this particular issue, and I think it's only appropriate that Brad be at the table because it was his leadership that produced a lot of the results here. So, Brad.
Yeah, a lot of the conversation was around the delivery availability period, so Brad, if you want
All right,
to
there we go.
explain that to us.
Good afternoon. Brad Nail with Converge Public Strategies. I think the easiest way to answer that is that a key component of the model is that the personal lines insurer, because this is a personal auto, the personal lines insurer that insures that vehicle can exclude coverage. So our model needs to make sure that the DNC provider has coverage in place whenever that personal lines insurer has excluded coverage. So it may be when they have just started their, turned the app on to indicate that they're available, or it may be when they're providing the actual delivery. And there are a number of different companies in this space that operate in different ways, so it's hard to have a one-size-fits-all to describe that, but the end result of the model is that coverage will be in place whenever it is not provided by that personal lines insurer.
Any other questions? Sir.
Thank you. So typically, when's a personal license going to end? When will that coverage end? What triggers it?
It depends on how they write it. They may choose, this is a supposition on my part, that they will not cover when you are actually providing, on the road, making a delivery, because that's commercial activity that they don't want to cover. So the concept of having to cover when you're just available to provide that, the personal lines insurer may go ahead and cover that time period. They may not change their policy language.
Okay, but what if they don't? Then is the person bare, or who covers
No.
that?
If the policy language is unchanged, then they have coverage through their personal insurer, as they would any other time. If the personal lines insurer excludes coverage, then the DNC has to have coverage to step in.
Okay.
If I could, Mr. Chairman, Representative Dunnigan, real quickly, the key language there is in Section 3A, and that is that it's really a default rule. If no other coverage is in place, then the DNC has to provide it during those applicable periods. It doesn't rule out that the private passenger auto policy might provide coverage through endorsement or otherwise, but if it doesn't, the obligation falls on the DNC. So.
Senator Hackett.
Yeah, and I totally agree, and I appreciate your thing, but you know, Uber and Lyft are a certain way, and you saw the problem with the insurance industry that that either model didn't work, so we had to develop a thing, and because they didn't want it to go on their personal auto when it was a business activity. Well, now you have companies that contract, like like Amazon, that will contract, and they have everything already set up. They're not always happy when the app, if someone's turning the app on. So, I mean, it's hard to get the legislation right, and usually we create a framework, and then they go to the states and get it right in each state, depending on the states. But can't we get this right here to protect like the Amazon types and also the Uber and Lyft types, because they are totally radically different in how their model works. Brad, I'm glad you're here.
I think we did get it right here. What we've done is, I think it's pretty clear that when they're making the delivery, that's the commercial activity that's got to be covered. When some of these folks operate like an Uber and Lyft, where they might be driving around, exactly, and so that is addressed here. And then for the folks that have more of a scheduling process, you don't really just drive around indicating that you're free right this second, but you're scheduled for a later time. I think that's addressed in here as well in the delivery available period definition, where the coverage is only required while you're actually driving a car and available to make that delivery.
So the coverage isn't there when they turn the app on? What if the guy's on a weekend, turns his app on to see what his schedule is next week? The coverage isn't there when the app?
Got to be driving a car while you're doing that.
Okay.
Yes, Senator.
So one more question, and I'm pleased with that answer you just gave. Thanks, Brian. What if there is a company out there, because these are mostly independent contractors, if not fully independent contractors, whose business model is, I'm going to pay you twice what my competitor pays, but in return, I expect for you to supply all of your own insurance and whatever else there is. I'm just curious if we're interfering with the free market in any way. Thanks, Brian.
No, sir. This model allows for the driver to provide their own coverage, so it has flexibility in that respect.
Seeing no other questions or comments, at this time, I will entertain a motion to adopt the model as amended. Have a motion by Representative Pollack. Second. All in favor? Aye. And model is passed. Thank you, gentlemen, for all your time and efforts on this. You've sure been a lot of help, and glad to get this one across the finish line. It will be, this model will be placed on the Executive Committee's consent calendar and will be hopefully adopted tomorrow at their meeting. We will now move on to our next model, which is the model to consider the NCOIL Dog Breed Insurance Underwriting Protection Model Act. I'll turn things over to Connecticut Representative Tammy Nuccio, one of the sponsors of the model, for some remarks. Representative, when you're ready.
Thank you, Mr. Chairman. I'm proud to sponsor this model alongside my colleague, Assemblyman Cahill. What's great about this model, as you'll hear from the people that are going to be speaking about it today, is that when we started discussing this a few meetings ago, it was very contentious, and there seemed to be that it was very contentious, and it seemed that a model may not be able to actually be achieved and adopted. However, in that time, we've had a lot of meetings. Everyone has come together to reach a compromise, and it's a great example of NCOIL serving as a forum where people with different views can engage respectfully with each other to discuss good legislation that meets the needs of all sides. You can view the model in your binder on page 285. As you can see, we settled on removing the data collection portion of the model and chose to focus on the restriction of the use of dog breed in homeowners and renters insurance policies. We also changed the effective date so that insurers will have more time to comply with the model's provisions. I appreciate everyone's work on this, and I look forward to continuing to work on it in my own House chamber in Connecticut. I think it's also very likely that we'll see this model legislation introduced in other states as well. I won't take up any more time, Mr. Chairman, as the substance of the model has already been thoroughly discussed over a few meetings. We've reached a point of agreement amongst ourselves, myself, Assemblyman Cahill, and all of the interested parties, including industry and the advocates. I thank you, and I look forward to the committee's support.
Thank you, Representative. Frank, John, Letty, I'll let you all briefly make some comments. I think we have some other folks who also want to speak as well, and then we have a couple other topics after this one. So.
Thank you, Mr. Chairman. We really appreciate having this opportunity to speak on this issue, and thank you for your leadership and the leadership of Assemblyman Cahill and Representative Nuccio. I hope that this issue didn't drive you away from the chairmanship because we think you've been a very, very good chairman. And we really appreciate everyone coming together to work on a framework that we can replicate throughout numerous states and keep dogs with their families, because people love their dogs, and we want the focus to be on the behavior of the dog and the behavior of the owner, not their breed. So again, thank you, and thank you for my friend Frank. I'm sure he will be happy not to see me at any more of these meetings. And John, too. So, and again, I hope I didn't drive Assemblyman Cahill out. So, again, thank you so much for your patience, and we appreciate everything you've done to keep dogs out of shelters.
There we go. You'd think after this many years I'd be able to operate a microphone appropriately. Mr. Chairman, members of the committee, once again, this is also an example of how the NCOIL process works. Those of you who have been attending these hearings know that this was an issue that could not have gotten any more contentious. Having said that, with the work of Assemblymember Cahill and Representative, the good lady from Connecticut, we were able to come to a workable solution on this. We believe that this model appropriately balances the need for insurers to assess the risks and price it accordingly, while on the other hand, understanding the public policy issues surrounding our relationship with our canine companions. And with that, Mr. Chairman, APCII urges the committee to support this particular model. Thank you, Mr. Chairman.
They were 180 degrees.
Thank you. Once again, John Schnautz, National Association of Mutual Insurance Companies. Very much appreciate the data collection provision being taken out. That was our concern with the model as it stood a few months ago, and without that, we have no further concerns. So appreciate the work on this.
Thank you all. I think we have some other interested parties who would like to make brief comments. If you could, maybe just a minute or so. Thank you.
Thank you, Mr. Chairman. Good afternoon, members of the committee. My name is Brittany Benessy. On behalf of the ASPCA, I would like to thank this committee for the work that has gone into the development of this model and for your receptiveness to input along the way. While the ASPCA ultimately believes that breeds should be excluded entirely from underwriting decisions, we feel that this model is an excellent place to start and look forward to working with state legislatures and helping keep people and pets together and in their homes. I respectfully ask for your aye vote.
Good afternoon. My name is Jessica Simpson. I'm with the Humane Society of the United States, and echo my colleagues' remarks and just want to thank the committee for your continued work on this important legislation, model legislation, and especially Assemblyman Cahill and Representative Nuccio for your continued dedication to ensure that people are able to remain with their pets and have appropriate coverage in their insurance. And with that, I ask for a favorable vote. Thank you.
Thank you all. Any legislators at the table with questions or comments at this time? Representative Anderson.
Thank you very kindly. I just have a comment to make. What a difference a day makes.
Thank you. Seeing no more comments or questions, at this time I would ask for a motion for the adoption of the model. We have a motion and we have a second? Second. All in favor signify by saying aye. 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 And the model is adopted. Congratulations. This model also will be placed on the Executive Committee's consent calendar tomorrow, hopefully for adoption there. At this time, we will move into the highly anticipated discussion around the NCOIL Insurance Underwriting and Transparency Model Act. This model is sponsored by Indiana Representative Matt Lehman, NCOIL Immediate Past President, and NCOIL Immediate Past President. And at this time, I want to turn it over to Representative Lehman for some opening comments.
Thank you, Mr. Chair. I'm just really glad we're on this roll of congeniality, and I think we're going to continue with this overwhelming support, but I do have my little alligator here for in case I needed to squeeze it. And I've said this before, I'm not going to go deep into the model, to be honest, because we have vetted this before, but I think, we've been having discussions for a long time now about the changing world of technology. Rating models are changing, information's being exchanged to our clients, and that's being used to affect their premiums. And so we really need to get to the why. And so the whole genesis of this a year ago is to get to a place where there's some transparency, so that when a person comes into an office of, I'm an insurance agent, I'll admit that, and we've always held ourselves out to be a professional advisors. We'll analyze your risk, we'll tell you what's best way to protect that risk and protect those assets, and then we go out and find the best product at the best price for you. When those prices change, right now, the answer I'm getting is, from my carriers, is we don't know. And so my response to my client is, why did my rate go up 18%? I don't know. And as we're sitting here, I got an email from one of my underwriters because I got a renewal, 2 vehicles, 2 retirees driving their vehicles around town. One vehicle stayed flat, the other vehicle went up $40. And so I just simply reached out to underwriting and I said, why did the 99 Buick go up $40? The response was, the liability symbol changed and therefore the rating changed. Now, will you give me $40 for that answer? Because that's what I'm getting. And so the frustration here is we have to get past the I don't know. So what we began to look at was, how do we get some transparency built into this? And this model was introduced, has taken 1,000 turns. If you look on pages 287 to 290, we've used as much red ink as Washington, D.C. It has moved. However, I'm hearing from a lot of people, there's still work to be done. There's still things that need to change. There was an issue around duplicative reporting. If we're doing this under the credit scoring model, which requires me to disclose the 4 things, don't make me do it again if that's really the factor. And we can work on those nuances, and I think we'll have some language on that. I think this really comes down to 2 issues that are in the bill that I think is causing some problems. One is the issue of declinations. Do we include, if someone is declined for not getting insurance, should they be given a response as to why? Again, 30 years in the business I go back to, I can tell you why. You're a horrible driver. You have 5 speeding tickets. You had 8 crashes in the last year. And then credit came along. We said, well, part of it is you're a horrible credit risk. Now it's just, no, we decline. So that's an issue. What number of factors should we say? I mean, is it 10? Is it 5? What do we need to disclose? Well, the credit model we passed, I think, is working in states, requires 4 things you have to tell the insureds. If you look at the banking industry, if your credit card rate changes, they're required to notify you what are the factors, I think it's 4 or 5, that caused your rate to change. So there's a model out there that says, just tell me why. So I don't know if that's the answer, but really what it comes down to is if the language we're looking for to answer the question if I don't know is out there, we've not found it yet. And I don't know if it's 10, 5, or just a true, transparent explanation that I can pass on to my client, or that my client can somewhat understand. So the other thing I'll say is this: if you look at the alternative, I've heard from the industry, we've got to play some defense here against what's happening in Washington State, which is we had a commissioner that said, don't like it, can't use it. Okay, just can't use it. Well, we'll back away from that. You can use it, you just have to disclose it, all of it. We'll back away from that. You have to disclose it. You have to, well, not all of it. You have to weight it. You have to tell us why it's weighted. And I think that as much as the brokerage world is saying, I don't know, the departments of insurance are saying, we don't know. And my biggest fear is when regulators say, we don't know, the answer is no. And I do think there's technology out there. I do think these models are very, very sophisticated. I think they're actually probably fairly accurate. But there just needs to be some transparency. And so I am concerned with the alternate, and that's why I really want to focus on not what you can and cannot use, but more on the transparency so that we do see what you are using. So I don't think we have found the magic language yet. I want to, before, and I'll defer to the chair on this, but before I would ask for this committee to move, I want to hear from the industry. I want to hear some of these questions answered is, how do we become transparent to our constituents? I had someone tell me, well, are people complaining about this? And I've had people complain. The person, now I got to go back to the office and tell them $40 for an I don't know. But what troubled me more was the departments have said the complaints are coming against the agent. Because we're hearing my agent's not telling me why I had a price increase. I don't know why you had a price increase. And so I think before this thing starts rolling downhill to where we can't get to a place, I do want to continue to work on this and get to the right place. So I want to hear what you feel about the model, your concerns with the model, and then what your plans would be moving forward to help us create that elimination of the I don't know. So with that, Mr. Chairman, I'll turn it back to you.
Thank you, Representative Lehman. We'll go ahead and start with interested parties. Frank, John, Wes, when you're ready.
Thank you, Mr. Chairman. Representative Lehman, I find myself in much more agreement with everything that you have said than I expected to be when I sat down here. So maybe it is part of the New Orleans atmosphere. Let the good times roll. So, or what a difference a day makes.
I can talk some more.
So we are 100%. Speaking for the members of APCIA, we are 100% with you in terms of the need for transparency, for the need for insurers to be able to cogently, coherently, and efficiently communicate to the producer community as well as to our policyholders, our customers, if you will, the reasons why something is happening to their particular policy. We agree with you wholeheartedly that answers such as, it's what the computer told us, are unacceptable. We agree that insurance speak, well, there was a change in symbol or there was a change in this or that is quintessential insurance speak, is not appropriate in terms of communicating that to a customer. Maybe the agent understands it and would be able to translate it for a normal human being. That certainly is, I think, something that's doable. We would like to be in a position, and we think that we are in a position here at NCOIL with the basis of the model that has been proposed in the sponsor substitute draft, which is reflective of some suggestions that the agents in APCIA and others provided to the sponsor. We think that we are a long way there. Unfortunately, at this particular point in time, we think that there are some additional changes that need to be made. For example, Representative Lehman noted the Fair Credit Reporting Act language. We think that that's a simple fix and, well, relatively simple, all things considered. We think that that is a fix that is going forward. There are some controversy surrounding whether declination should be included or not included. My association is agnostic on that particular issue. But there are some other provisions, particularly around a very lengthy and somewhat confusing sentence concerning the 10 factors, which we think need more work, need more thought. I've said this to a number of people. I'll use it at this table, and I don't want to in any way denigrate the product that we're attempting to produce here. The cake isn't baked on this yet. I think this cake needs to stay in the oven a little bit longer, and I think that we can, as an industry and as a group of public policymakers, produce the type of result that will position NCOIL as a leader on this particular issue, as NCOIL has been positioned as a leader on the 2 models that you all just approved. And I think that there's an opportunity to do that here, and we look forward to working with this committee. We look forward to working with Representative Lehman on what could be one of the most important aspects of public policy related to insurers and how we relate to our customers that we may be working on in the next few years. And with that, Mr. Chairman, I think I'll end there before I get myself into any trouble.
I'll also try to avoid trouble. John Schnautz, National Association of Mutual Insurance Companies. First, Representative Lehman, I do want to say in respect to your red ink comment, you are absolutely right. You have made a lot of changes that I think have come directly from long and I think for you painful conversations that we've had that I appreciate. I think you've also identified the remaining issues that we have very succinctly. The idea that we have been pushing here from the beginning is that the key here is value. Companies can, large companies at least, can probably build systems to make whatever sort of disclosures you would want them to make. The question is, those are not cost-free systems. We have some idea from the Washington regulation, which it's not fair to compare to this, but we know those can be very costly for both big and small companies. And so the question is, what is the cost of that, which ultimately will be borne by policyholders, versus the value to policyholders? And that's the needle that we're trying to thread. I will say on the declinations issue, that is one of our remaining issues. The reasons are several. One is from the comments you made at the beginning of this were all about premium increases. That has been the most acute discussion here in terms of what the issue is, and we think that's appropriate. There's an existing contractual relationship there, and some explanation makes more sense. To give an example of the interaction between a couple of the provisions that are still in the bill that we think are problematic. So let's take the declinations provision, the fact that it's still included, and the 10-factor sentence that Frank referenced from Section 4C of the model. So I think it's a reasonable reading of that to say that if a potential policyholder is declined, so that's a binary choice, yes, you write them, no, you decline them, that company, to comply with that, would have to go through every relevant factor that it used in that decision, rank them, try to figure out what the top 10 are, and then report them to that policyholder. And doing that is not a very simple thing, because it may not be a binary issue of just one of those factors. It could be a combination of all of them. And I think that sentence is so prescriptive that, particularly in the context of declinations, it creates a notice that would be very hard to produce and probably of very little value, because frankly it's not going to change the company's answer on whether they'll write the coverage. The person's going to have to go find coverage elsewhere. So I think that's a good illustration. And the credit interaction issue, I think that one is fairly easy to address, and I don't think anyone here, Representative Lehman included, wants it to be duplicative, and we agree with that. So we would look forward to the chance to continue to work on this. We've been working on it for a while. We think we've done that in good faith to try to reach something that we could not only not oppose, but possibly even support, because I think, Rep. Lehman, you're right. This is an emerging issue, and it is a tough one to crack, and the industry would benefit from greater public confidence in what it is doing, and we want to find the right answer there. So thank you. Happy to answer any questions.
Is that on? The light doesn't work on it. Is it on? Can you hear me? All right. Sorry. Like Frank, I need an assist getting the mic to work. I'm Wes Bissett, Senior Counsel of the Independent Insurance Agents and Brokers of America, the Big I. I'm going to put my reading glasses on here in an effort to look smarter and perhaps more credible. We are big supporters of Representative Lehman's efforts, and I'll walk you through some of the reasons why and hopefully not reiterate many of the comments that Representative Lehman made. We do see a need for this model. The underwriting and rating process in the personal lines world has become increasingly complex and opaque in recent years. Companies are using advanced analytics, vast new types of data, and complex models that just weren't in place even a few years ago. And the results that these models sometimes produce are counterintuitive. You know, as Representative Lehman said, it used to be much more intuitive in the insurance personal lines underwriting context. If you had a lot of accidents, you could imagine why your rates went up, or you had teen drivers coming on your policy. There was a natural tie and much easier to understand. But when there's these large rate increases that are counterintuitive, it leaves people wondering why, and in some cases could potentially lead to an outcome where people are wondering if the price they have been quoted really represents the risk that they ultimately present. And agents, struggle to provide, not all the time, but struggle to provide explanations for customers who are kind of wondering exactly why their rate went up 20% or why they were non-renewed, and it can lead to false conclusions that we don't want to have occur. So basically all the model would do would be to establish some basic transparency in this process if requested by the customer. If a consumer was non-renewed, or if their rate increased 10%, and it's not just 10%, it's 10% above whatever broad-based base rate increase would occur, that they could then ask the insurer for a list of the primary reasons for why that decision was reached. So hopefully it would do a few things. It would hopefully facilitate a basic understanding of the reasons for that increase. If the information that had been utilized was incorrect or inadequate or incomplete, the consumer could then go back and take action and potentially improve their outcome. And hopefully in a big picture way, all of this would help restore faith and trust in the insurance rate making process. And some might look at this and say, man, this is radical, this is coming out of left field, but honestly, this is not a new or novel context. There was a big data revolution that occurred about 20 years ago when companies began using information based on credit histories and credit reports in underwriting. And actually 20 years ago at this very meeting, NCOIL adopted a comprehensive model that established a broad regulatory framework for how credit information and histories could be used by the insurance industry. What's ironic is at that time there were companies who were really skeptical of that NAIC or that NCOIL credit model, and they've become big supporters and believers in that in the years since. But among many of the provisions in there was one that Representative Lehman mentioned that requires, if an adverse action is taken, that the reasons for that be explained in, quote, clear and specific language, unquote. That's been broadly adopted. It may be NCOIL's most successful model. And so there's already an adverse action disclosure requirement when the information, the underlying information, is from a credit history or credit report. And all the proposal does here is essentially keep up with the times as data is changed and kind of require the same type of adverse action notice given the new underwriting and rating factors that are being employed. And the other issue is we're behind the banking industry on this. For many years, federal law in the form of the Equal Credit Opportunity Act and Regulation B has required disclosure of the specific principal reasons for adverse actions that occur in connection with an application for an extension of credit. And that applies to complex algorithms too. The federal regulators have said, you're not even allowed to use a complex algorithm if you can't, when an adverse action is taken, explain the reasons for that action. So there is a need for a proposal like this. There's just, in particular, a need for a reasonable and legislative-based model of this nature. We already have individual states. We have the NEAC that are contemplating action in this particular context. So having an appropriate, narrowly tailored model is incredibly important, especially because requirements like this ought to be established by statute, not by sort of unilateral regulatory fiat and by regulatory action. So having a transparency-based approach, we believe, is the right direction being big supporters of the state system and of the risk-based pricing model and framework that we have. The other thing I'd say is whether you ultimately consider this today or in the future, we'd urge you to move forward on this, even if you conclude this is not something you want to bring back to your home state and act on, maybe now or even in the near future. But there is sufficient interest among the states that are going to be looking to do things like this, that it would be helpful to have a reasonable, narrowly tailored model and not have those states acting on this in an ad hoc, ununiform way. So again, I'll close by saying that this merely keeps up with the times, the news, and the emergence of new data sets and complex models, and we think it's reasonably and narrowly tailored in its current fashion. So whether it's today or in the near future at an interim meeting or in San Diego, whenever you take this up, we'd urge your support. And I hope if it is delayed, I was born at night, but not last night, and I hope any delay would not be an effort by some who have concerns to essentially kill this altogether, and to truly, and in good faith, come to the table and negotiate and make this the best product it can be. So thank you very much, Mr. Chairman.
Thank you all for that. I think at this time we'll go to legislators at the table for comments or thoughts on where we're at with this process, and then we'll double back to Representative Lehman for his thoughts then. So Senator Hackett.
Fantastic. First of all, I want to thank Matt. I mean, Matt, you worked so hard on this. I mean, people don't realize how long he's been on. We went from a task force on discrimination to this issue, and Matt reminds me of a really buddy in Ohio that he takes the toughest issues. And Matt knew, I mean, there's no surprise at all. I mean, Matt knew this would be a really difficult issue. I mean, just some points that I want to make. You know, look what Matt said is that, we've moved in more into the modern age, and these formulas are a lot more intricate, but they are probably a lot, they probably are more actual than the old days. See, the problem I think my guys have is we're worried about the cost of this. And the one gentleman, I agree, you look at cost versus value, and I agree with that. But, the room knows we're good Republicans, so we want to control costs. We don't want to create a business environment that it's really cost. And I've always said as insurance chair that, good legislation is legislation that's good for the consumer, good for the producer, but also good for the company. And so that's why this is a really, really difficult issue that when we deal with this. And so, this is something, I get on the insurance companies because, and I do, Wes, that, we have to get this resolved. And you know this and I know this, that it's the smaller insurance companies are the ones that are objecting the strongest because they're just looking at what it's going to cost them to put this into place. And so, that's all I want. I mean, I defend Matt to the end because Matt has worked on this as a really, really difficult issue, and he's working hard to get a solution on it. And we're close. And the only message I give the insurance companies, we got to get this resolved in the next couple months because if we sit on it much longer, some states are going to go act on their own, and they're going to be a lot more strict than we will even like under that scenario. So we got to be careful in the message we send. But, cost is such a major issue that we worry about creating additional regulations and additional costs that are they needed on that. And Matt, I understand from what you said as a producer. I'm not a producer in P&C, but I'm a producer on the financial end on the insurance side. And I realize that. I mean, it's changed. This industry has changed drastically. And I do think it's for the better because it's more accurate, I think. And so that's why. I just want to do that. I think it's great that the insurance industry wants to get this resolved, but we want to get it resolved quickly, on that. If we postpone it, which looks like we might another time, but let's get it resolved. Thank you, Mr. Chairman.
Okay, we'll come right back to the legislators, but I think Frank would like to respond or make a comment.
Yes, thank you, Mr. Chairman. As my family, friends, and colleagues remind me, I am often disagreeable. But today is not that day. Senator Hackett, I agree with everything that you've said. Wes, I agree with most everything you've said. But we need to get this right. We have worked very hard on this. We do understand that part of what we're talking about is the credibility of the insurance industry in the product that it delivers. And people want to know that they have been dealt with fairly. And in terms of dealing with people fairly, they want to know what happened, they want to know why it happened, and they want to know in such a way that is understandable and so that they can make an appropriate decision. We want to be in a position where we can take this legislation and put it in place in our companies so that it can be put in place as a standard practice in such a way that it is cost-effective and produces a result that's going to generate the desired result, which is people know what's going on. We commit to the sponsor, we have said to the sponsor, we commit to the committee and commit publicly that we are all in on this, and that our concerns and our requests for a delay are in no way dilatory or intended as an artifice to end up with a result that produces nothing. It's important to get something done and something done right.
Thank you, Frank. We'll now go to Representative Anderson.
Thank you, Mr. Chairman. And first of all, I want to say thank you to Representative Lehman for all of his hard work, and also to say that he has a champion of a heart because he cares about everybody and everything that is going on. And that's why we are hearing him talk the way that he's talking today. And to thank Mr. Frank, Mr. John, and Mr. West for coming before us today and agreeing. I heard from my folks back in South Carolina today, from the insurance side of it, and this is what they said to me. Representative Anderson, please have them to remove the premium increase language from the definition of adverse action because it's unnecessary and confusing to lump together premium changes and declinations. We in South Carolina already have laws on both of these subjects. And then secondly, they said, please do not make a violation of this proposal to be punishable under the Unfair Trade Practice Act. And so I just want us all to consider all of these things, and I'm sure that around this table there are others who have heard from insurance companies in their area. So that's my 2 points. Thank you very much for being here.
Thank you. We'll go to Representative Mayfield next.
Thank you so much. Thank you to Representative Lehman for bringing this language. When I saw this bill, I got extremely excited. In addition to sitting on insurance, I also sit on the Consumer Protection Committee, and this bill, as written, even with the objection of industry, would pretty much fly out of the Consumer Protection Committee because of the way it is written. We want more transparency. Policyholders deserve transparency. As Mr. O'Brien stated, they want to know the why, what happened. And I do believe that as an industry, you owe it to them to provide them with that why. They don't want to hear about complex algorithms or anything else. They just want a simple explanation. And I believe that can be given to them. So thank you for this. If it does not proceed, you will see it in Illinois in a form probably something that you would not like. So it'd be great if we could get, uniform language as opposed to 50 different versions. Thank you.
Thank you. We'll go to Senator Lang.
Thank you, Mr. Chairman. Thank you all very much for the work that you have done. Similar to Representative Lehman, in the private sector, I play in the insurance business as well. I own an agency that's a life and health agency, and I know it's not the same as P&C, but also own a captive insurance company that's in the P&C world, and it's a very narrow market we insure, so it's not car, it's not homeowner, so my experience is not similar to Representative Lehman's, but in my experience, a client that gets declined pretty much knows the reason why they've been declined. In the insurance world that I play in the private sector, that's my experience. My question is, I would like to follow up on Senator Hackett's comments about a cost increase. We know this will add cost. We know this will add complexity to the system. My question from the industry is there any estimates on what it would cost on a per individual basis across the board? And is there any estimates what it would cost the industry if all 50 states were to adopt this on an aggregate basis? And furthermore, as it relates to that cost, is it fair to assume that the insurance companies would eat that cost, which would result in a negative impact on their EBITDA, or because of their fiduciary responsibility to their shareholders if they're a stock company, or to their policyholders if they're a mutual company, would it be fair to assume that whatever that increase is would be passed along in the form of increased policy, which would most likely have a negative impact on our nation's working class people more than just about anybody else? So thoughts on price increase and the impact on the industry? Thank you.
Take a shot at that one. Senator Lang, thank you. I referenced early on the only cost estimate that I'm aware of that is related to something close to this were cost estimates that the industry did on the Washington transparency regulation. In fairness, I don't think you can take those numbers and apply them to this. I could give you some indication of what those were, but I don't want to leave any misimpression that that's somehow transferable to this. For large national companies, those costs were generally in the tens of millions of dollars, and for smaller companies in the single millions of dollars. The answer to where those costs are born is insurance companies don't print money. Everything has to be paid for somehow through the available sources of revenue to the company. I think that's the best way I can answer that. But again, to be fair, the Washington reg is different. We know this would cost something. We don't know specifically per policy or anything like that.
Those are great questions. I think there's a few things to contemplate. The short answer is I don't know to your question. But the things to potentially contemplate would be, is this offset by savings that carriers are enjoying because of the complex modeling and the increased accuracy that would occur? And one thing that might be worth exploring too would be what types of costs, if any meaningful costs did occur as a result of companies complying with the adverse action requirements under the credit scoring model from 20 years ago. There's probably data out there that we could look to. It would also be interesting to look at how and what costs there are, if any, on the banking industry as a result of their compliance with very similar requirements over the last few decades. So, I mean, those would be things that we can perhaps explore and take a look at. So, thanks.
All right, we have three more legislators that want to get questions in, so we need to try to do those quick. We got to go back to Matt, and then we'll have another topic or two after this. So we'll start with Delegate Westfall.
Thank you, Mr. Chairman. Don't really have a question, just a comment. In 12 days, I'll be an insurance agent for 43 years, and I do try to answer these questions daily. It is a problem, but I just don't think we're there yet. Talked to a lot of insurance companies besides the one I represent, and they're not against this, in my opinion, but they just want to get it a little better what it is. If we pass it now as it is, we take it back to our home state, we've got to tweak it, I believe some. I would have to, and I don't think I'd have the ability to really do it as well as the committee could do. I'm all for taking this next year and probably trying to pass it in West Virginia. And I've got a pretty good record of passing bills out of the NCOIL. I do a lot of them. But I'm not comfortable with this one right now with the way it is. I think we need to work on it a little bit more. I think he's going in the right direction. I'd just like to see it tweak a little bit more, though. Thank you, Mr. Chairman.
Thank you. We'll wrap up with Senator Mills and then Senator Filskowski.
Thank you. And for background, I'm strictly a consumer of insurance. A business background, I'm a member of the Insurance Committee in the State of Louisiana Senate. And we've talked about this exact issue for some time in there, and I was amazed to find out that there's over 100 external consumer data points that you can buy on an individual. And, in my mind as a consumer, Matt, if you ever said you don't know the answer, I take it at that value. And I said, well, what are my options? I'm much more concerned as a consumer about having an option than I am an explanation, and particularly if the explanation is going to cost me money in my next policy. But, and I apologize, I don't know enough about the banking rules relative to something similar to this, but I surely want to study that. That's going to take some time, and I'm going to ask for some time on this as well. I live in probably the most litigious state in the nation, and I know that if you put just 10 of these external data points out as to the reason that you were either given an increase or a declination, I've got thousands of lawyers just giggling at the idea of one by one knocking those off. And we're going to be tied up in the courts every time with lawyers in my state. And I just am nervous as a cat about putting these external data points out in the public realm. I know that they exist. I can live with that. I just want to know what the rate is. Give me my options, give me my rate, let's go forward. And so I would suggest we defer this.
Thank you. The last question or comment from a legislator on this topic will be Senator Filskowski.
Well, thank you very much. And I do want to say thank you to Mr. Lehman for all his work on this, but I have to respectfully decline on this. I've been an agent since 1985, and we do a lot of P&C. I do mainly commercial, but home and life auto. You are literally asking companies to put out models that I agree are going to cause a whole lot of litigation. But also think of this. If an agent's putting a policy and it's getting declined, it kind of means they're not doing their job to start. You know what your underwriting guidelines are from your companies, and if it's a tougher risk, you should be having those conversations. So the declination of coverage, I think, should be out of there. In addition to that, we're one of the most highly regulated industries in the nation. And when rate increases happen, those rate increases are approved by OCI and your insurance departments. And, you know, I'm just going to look at the one company I've got. There's 1,000 different factors that go into their logarithm. So everywhere from, you know, what are the weather patterns? How far are you 8.1 miles or 8.2 miles from your responding fire department? Yes, credit score is a large part of it, but there's other that are part of it. And I think the minute you start saying that, you know, they're using X, Y, and Z to rate, all of a sudden it's going to be like, well, one is discriminatory, one is not. This is bad, that's not. And I just think we're going down a rabbit hole on this that we absolutely don't need to. And my final question is, why? Is it so agents can say to you, you know what, your credit score dropped 10 points? Or is it that the weather patterns are changing in Oklahoma and we're seeing much more damage in that area? So we're going to add the cost of doing this, but what are the consumers actually going to do? Now I'm going to know why I'm being charged more, and it's going to cost me more to know that, but we can't change weather patterns, and we can't change a lot of other things. So we have a robust insurance market in this nation. You can shop your insurance and find out if you can get a better deal with more coverage and through other people. I just think we're going down a rabbit hole that doesn't need to happen.
Thank you, and thank you for all the discussion there. I'm going to go back to Representative Lehman for some thoughts on where he thinks we're at.
All right, thank you, everybody. I appreciate all that. I thought this would really go smoothly. I appreciate all the input, I really do. And I think what I've heard, and the only pushback I'll have on a couple of comments more is when you mentioned about the department's already approved rates, they're saying we don't know how to approve these because we don't have the expertise to dig into these models. We just don't. And I think when you mentioned 100 data points, we're not talking 100 data points. We're talking 1,000 data points. You know, when we're talking about it, in Indiana, I had simply asked a very simple question. How many data points has a carrier asked to use, and how many have you approved? I just have one example. And they said, we had a carrier that asked to use 1,400 data points, and we approved like 620 of them. And I'm like, which is more appalling? That there's 620 things about me that are driving my rate, and some of it is as simple as you live in a tornado alley. But what else is in there? Or is it the 700 plus that were denied Because what did you ask for that the department said, no, you can't use that? So I think we're on, when you talk about going down a rabbit hole, we're already in the rabbit hole. Okay, we went in that rabbit hole when all of a sudden technology said, I can put a little box in your car and tell you how many times you stop and turn left and calculate your rate, and everything else. I mean, so we're there. It's just going to be, how do we craft this to be efficient, fair, and transparent? This is my 37th NCOIL meeting. Okay, now one thing I've learned in those 37 meetings is get it right. Okay, and I don't take ownership of things, so I want to get this right. I would like to, I've already talked with our bill drafting people in Indiana. I'd like to work on a bill. I think it's that important. I'm going to ask, I've renamed my alligator Frank and John. Because as we have this discussion in Indiana, I am asking for your help. And I do think the industry, and I have great respect for everybody at that table, because you've always been upfront with me and been fair with me, and I look forward to finding that right path so that the answer of I don't know becomes I can tell you why. And I think that's what we owe to our clients. And so with that, Mr. Chairman, I am willing to hold this. I will look to see what we do in Indiana. By March, it will have been through the House of Representatives. So I think we'll have something that has been vetted by the committee, vetted by the industry, vetted by consumer groups, and vetted by all those who really want to see some transparency. So with that, I appreciate everyone's comments, open to more discussion. So please reach out to me. But this time, Mr. Chairman, I'd ask that we hold this until San Diego.
Thank you, Representative Lehman, and for your continued work on this important issue. Thank you all. We'll move on to any other business at this time to come before the committee. Representative Carter, I believe, has some comments she would like to make to the committee.
Yes, thank you, Mr. Chairman. I'll be very brief. I'd just like to say that this past year I worked on a bill that deals with liability insurance requirements for firearm dealers. I think with everything that's gone on recently surrounding that issue, NCOIL should have some sessions regarding liability insurance and its relationship to firearms and firearm dealers. That's all I have. If anyone would like to speak to me about it, please don't hesitate to reach out to me.
Thank you. Any other legislator with any other business to come before the committee? If not, I just want to say that it's been an honor to chair this committee for the past 2 years and to get to chair the P&C committee during Representative Lehman's 37th meeting. I took count when we started this afternoon, and there were 37 legislators at the table, and I know there were more in the room, and I can remember the days when there might have been only 10 or 12 of us in here. So it's a testament to the way that this organization is growing, and I wish you all the most success. And with that, I'll entertain a motion to adjourn.
So moved.
Adjourn.